Notice is hereby given that the 17th Annual General Meeting of Kingston Properties Limited will be held at Courtleigh Hotel and Suites at 85 Knutsford Boulevard, Kingston 5, in the parish of St. Andrew in Jamaica on 11 June 2025 at 10 a.m. for the following purposes. 1. To receive the audited accounts for the year ended December 31, 2024, and the reports of the directors and auditors. The company is asked to consider and, if thought fit, pass the following resolution. Resolution 1, that the audited accounts for the year ended December 31, 2024, along with the reports of directors and auditors circulated with the notice convening the meeting, be and are hereby adopted. 2. To declare final dividend. The company is asked to consider and, if thought fit, pass the following resolution. Resolution 2, that the interim dividend of US $0.000566 per share paid on June 5, 2024 and US $0.001058 per share paid on December 18, 2024 be and is hereby declared as final for the year ended December 31, 2024. 3. To re-elect directors. A. The directors retiring by rotation in accordance with Article 107 of the company's Articles of Incorporation are Mr. Peter Reid and Ms. Lisa Gomes, who, being eligible for re-election, offer themselves for re-election. The company is asked to consider and, if thought fit, pass the following resolutions. Resolution 3, that Mr. Peter Reid, retiring by rotation, be and is hereby re-elected. Resolution 4, that Ms. Lisa Gomes, retiring by rotation, be and is hereby re-elected. 4. To appoint the auditors and fix their remuneration. The company is asked to consider and, if thought fit, pass the following resolutions. Resolution 5, that KPMG, having signified their willingness to continue in office as auditors, the directors be and are hereby authorized to agree to their remuneration in respect of the period ending with the next annual general meeting. And 5, to transact any other ordinary business of the company by order of the Board of Directors, signed by yours truly, April 24, 2025. Thank you.
All right, thank you, Madam Secretary. I am going to now provide you with some very brief remarks before both the Head of Finance and our CEO gives you a more detailed overview of the business. So the first thing I want to do is introduce our solid board of directors, who are at least partially responsible for the results you're going to hear about today. Starting with myself, I'm Gary Sinclair. I'm the original chairman of Kingston Properties from 17 years ago, followed by our original company secretary, you just heard from, Ms. Nicole Foga. Then Gladstone Tony Lewis, who unfortunately sends his apologies. He couldn't be with us today. Followed by Miss Lisa Gomes, who also is unable to be with us today. I believe Lisa is off island. Followed by Mr. Peter Reid, who is with us today, sitting in the front row. Peter, I think, has been a director now 10 years, at least. 14 years. So I said 10 at least. 14 years. Mr. Philip Silvera, who also sends his apologies. Couldn't be with us today. And then Mr. Resworth Burchison as well is a director who also sends his apologies because he couldn't be here today. I think I also want to recognize our important partners and key stakeholders, our auditors, KPMG, who are represented here today, are the trustee services provided to us by our registrar at the JCSD, and then other outsourced partners and key stakeholders, EASL Media and PUR Communications, our communications partners. One of the things that I think's characterized KPREIT's evolution over the last 17 years, and we've tried to strengthen year in, year out, and I think is a result of the fact that we are a public company, so it forces us to focus on this area of our business, and that is governance. I think our governance structure was always strong, but we continue to focus on strengthening it so that we're able to deliver for all of our stakeholders. So that strong governance structure begins with our board, as I mentioned, 7 independent directors and 4 board committees with annual reviews of charters and terms of reference, an ongoing board evaluation and training program, board skills, including the board skills that exist as part of our board team includes investments, finance, accounting, real estate experience, human resource experience, law, and risk management. We adopted the comply or explain principle of the PSOJ code on corporate governance to strengthen our corporate governance structure and its accountability framework, including conflicts of interest and whistleblower policies in keeping with global best practices. We've improved our rating to A, an A rating in the JSE Corporate Governance Index rating, and these are the kind of KPIs and metrics that we follow actually quite closely because we think it has a direct bearing on the commercial results and outcomes. Deliberate and consistent communication with all of our stakeholders is absolutely important to us, and we have a dedicated investor relations office for shareholder queries, and we host earning calls and investor engagement sessions as part of our transparency mandate. So some key highlights, I think, comes next of the prior year, which you'll hear a bit more about when both Kevin and Andre come up to speak. But we're in the business of acquiring and leasing out real estate, and we concluded our first investment in the UK market. And again, we are opportunistic real estate investors. We search out and will invest in markets that demonstrate stable democratic principles, a strong rule of law, strong especially real estate rules of law, stable and preferably appreciating currencies, certainly against the Jamaican dollar, and solid economies, economies that are going to generate, we think, future growth. And we think the UK is one such market. So we concluded our investment in 2530 Aztec West Business Park at the end of 2024 in December. It's 20,000 square feet of office space in Bristol and is home to a number of major players in the UK market, in the aerospace, defense, engineering, financial services, media, and environment services industries. We also managed to acquire last year 6 and 8 to 10 Duke Street and the East Street parking lot, all in downtown Kingston in August of last year. 2 buildings located in those locations. The buildings comprise a total square footage of just under 60,000 square feet. The East Street parking lot was also acquired, and it services the occupants of both buildings who are major players in the banking, audited, and financial services industries. We also managed to reorganize our debt, which is obviously an important component of the overall business model. It's crucial to be able to not only access, but continually access very efficient financing options. And we think we did a good job here in receiving a wrap facility from CIBC Caribbean that provided $21 million to us in senior secured term financing to refinance existing debt and to support additional acquisitions. Financing helped us reduce our funding costs. We got that wrap funding at a very low and a much lower interest rate, and it's obviously enabled us to expand our portfolio of assets and buildings under management. But it's not our only source of financing. We're active real estate investors, so we acquire, but we also dispose of properties. I think we did a good job last year in disposing of Tropic Center 1 in Cayman, which was a mixed-use property comprising of office, retail, and residential spaces. The majority of the units were sold prior to the close of 2024 and were entirely sold in January, resulting in an approximate IRR of 16% unlevered and 26% on a levered basis. And as I mentioned, leverage is a key component of our overall business model for just this reason, the returns you're able to get on a levered basis. The next highlight is our Gumtree warehouse project, again in the Cayman Islands. We obviously completed that and entered into an agreement to acquire 3 of the 4 pre-construction units. The units were completed in 2024 and represent our first greenfield project that has been undertaken and completed. And I believe it's safe to say that we have leased out all of the 3 properties, warehouses that are part of that project. And then finally, from a project standpoint, the Rousseau Road Greenfield project. They're in Crossroads, another warehousing space that we're in the process of constructing right now. I'm happy to say, have broken ground. We've ordered our fabricated steel, massive fabricated steel structure, which is almost complete, and we expect to actually be leasing property in that warehouse complex in January of 2026. And I'll knock on wood there because construction is always tricky in Jamaica. So next, we just want to share some quick facts about the prior financial year. We hit a record in total rental income of $4.7 million US. We delivered cash from operations of, again, another record. I mean, we keep hitting successive records of $2.5 million. We had a dividend yield of 2.7%. Total revenue hit another record of nearly $9 million US. We paid gross dividends of $1.4 million last year, and there's more to come, right, Kevin? Square feet now owned are 675,000. You know our goal is to get to 1 million square feet under management. Our net profit, $5.4 million, another record. And that's US dollars again. Last year, we generated funds from operation of $766,000, and we've managed to maintain through a combination of very vigilant building and property management and diversifying the various areas in which we invest. We managed to maintain a 93% average occupancy rate throughout the year. Just to sort of give you some highlights of how we have progressed over the last 10 years or so. Since 2015, we've gone from $14.7 million in assets through obviously generating profits and retained earnings, but through judiciously acquiring debt financing, as well as some additional public offers. We've gone back to the market a few times. We've gone from $14.7 million in 2015 to 86.6, nearly $87 million in total assets at the end of 2024. And that has all had an impact, I think, which is where the rubber meets the road, on our stock price, which has moved from $6 in 2019 or $6.63 in 2019 to $9.43 at the end of 2024. 2024. So all of the activity that we've engaged in is in furtherance of obviously generating dividends and solid risk-adjusted returns to you as shareholders, but the key obviously is generating a business that generates the kind of total returns that we are generating now between the dividends and the increase in stock price. And we are focused on that combination like a laser, and we're going to continue to focus on that into the future. Finally, our key strategic imperatives, which again, I think we should keep reminding our shareholders where we are headed. We're not just sort of, moving from building to building. We have some key strategic imperatives out there in the future that we are focused on hitting. The first is assets under management. I showed you how that's moved from 16 million in total to $87 million at the end of last year. The target is to get to $100 million, hopefully by the end of this year, in assets under management. Our return on average equity, the outcome has already surpassed our big target for 2025. Last year, we hit 11% in return on average equity last year. So we have to move those targets, Kevin, for sure, because clearly we're feather bedding that target. We need to move that up. And we need to get funds from operation, the cash available primarily to pay dividends, certainly as far as I'm concerned. We need to move that from 776,000 where it was in 2024. The target for this year is to get that to $2 million. Not an easy task. It's certainly not going to be easy, but then, that's why we are here, right, Andre, to do what is hard. So with that, I'm now going to be able to turn you over to Andre Francis, our Chief Financial Officer, who's going to give a little bit more detail on the numbers. Thank you.
Welcome to our AGM. I'm happy to present these numbers to you for 2024. It's another good year in my book in terms of how we operated and how we delivered as a company, and so I'm really happy to share these numbers to you today. All right, so I'll start off with our core rental income for the year. This is the core cash generation of the business. So last year we did 4.7 million in our core rental income, and that growth is about 23% higher than the previous year, right? Primarily driven by the growth in our portfolio. If you remember, in 2023, we acquired Grand Harbour at the end of the year, and that has propelled the growth in our revenues for 2024. In mid-2024, we also acquired the Duke Street properties, as the chairman just alluded, which contributed significantly to the growth in our rental income as well. Naturally, we also have our adjustments to our rental rates, primarily in Jamaica, as we have the built-in annual adjustments in our lease agreements that will help us to propel rates. So all in all, these are significant in understanding how the business is positioned for growth in this core cash generation aspect of the business. So for instance, as I said, with the addition of the assets, the Duke Street asset in mid-year, and the addition of the UK portfolio at the end of 2024, we're already positioned to have growth in this core income even into 2025 as we stand now, and probably even beyond up to 2026, right? So the business is structured to have that level of growth in the core cash generation aspect of it, right? So our total revenues for the year was $8.9 million, and this is a record hit again, as the chairman alluded. And this shows the diversity in our revenue stream. So not just the rental income, but also our asset values grew significantly over the year as we managed these assets. So last year recorded a $3 million uplift in our fair values. And we also realized $1.5 million on the disposal of one of the properties, Tropic Center. We disposed that last year, the bulk of it, and we realized $1.5 million. So it shows how we are managing and creating value in the assets with the value add strategy, and we're also realizing that benefit as we dispose of the assets. Okay. So that translated into our net operating income growing by 13%, which is basically our rental income minus our operating expenses. So we recorded 2.8 million last year versus 2.5 million in 2023. And it shows that we're also managing our expenses as we grow the revenue. So it's translating into a growth in our operating income, and also translating into our net profits for the year, which we recorded a record net profit of $5.4 million compared to the $4.6 million, which is a 16% growth over last year. And this is after we've accounted for our net finance cost for the year, right? So just want to touch slightly on the FFO in terms of how the chairman mentioned. This is a key metric, I know, for shareholders, because it does drive what we do as dividend. It's our dividend policy is based on that. We did 776 last year, and we had some challenges last year, which, like any other business, we do have some challenges. For the first time since I'm here, over the last 5 years, we had one of our significant customers going bust, basically. They went into bankruptcy. We had to write off a bit of bad debt there, you'll see. One of our property in Cayman had some vacancy throughout the year, which caused some one-off expenses that has to be accrued to the landlord as we manage the common area maintenance. And there was a bit of mismatch with some expenses interest expense as we secured the financing to make the acquisitions, and there was a bit of timing gap between the acquisition and actually securing that financing. So those challenges would have caused some dampening of the FFO, but what I like to call the 4D diversification strategy, in terms of the diversification of our income, diversification in the tenant base, diversification across the regions. These things all help to provide that recovery that we needed. So when we dispose of that asset in last year, recording a higher than planned gain on sale, it allowed us to recover even though we had a low showing on our FFO. Right? And so the business is kind of structured to be solid and resilient to these shocks that we'll face sometimes. Right? So 2024 basically continued the story of growth for us. Over the last 6 years, we've had an average growth in our primary profit metrics, and our annual compound annual growth rate on rental income was about 19%. In operating income was 27%, and in our net profits, our compounded growth over the last 6 years was 16%. So we continue that trajectory, and we are expecting that to continue as we build the business. Right? All right, so just turning a bit now to our balance sheet and our assets. Our assets grew by 22% last year to $86.6 million, and that's up from $71 million the prior year. And this is primarily due to the acquisition of the Duke Street properties, 6 Duke Street and 8 to 10 Duke Street. And we've also added our 2530 Aztec West in the UK. So those two additions would have been a primary driver. Our asset values also grew by about $3 million in terms of fair value as at the end of December. And this is amidst the sale of Tropic Center. So basically we are able to grow the portfolio. And that translated to an increase of about 8% in our overall total equity, right? Which works to be about a $9.17 Jamaican in terms of our book value per share, right? So this is translating into the bottom line even after we paid the the dividends for the year, right? So just a look at another aspect of how we finance the business, which is our loan portfolio. So that grew from $22 million to $33.7 million last year. And that we know went directly into funding the growth in the portfolio. And as the chairman alluded to earlier, we were able to refinance the existing debt with our previous loan partner, albeit that was already a low rate, but we're still able, based on the strength of KP's assets and balance sheet and how we do business, we're still able to generate lower interest cost on this facility and increase the amount of debt that we're able to access in the market. So our portfolio of debt grew, and that was used to acquire additional assets and to enter into this new UK market that we did. But our loan ratios still remain conservative. Our loan as a percentage of total capital as of 2024 was 39%. And when we compare that to the international REITs, we do have a batch of international REITs that we tend to compare as for a metric just to see how we are doing. Those composites are normally about 50% on average versus our 39%. So we're still maintaining a good conservative ratio on our debt portfolio. And just to give a little more detail on the other loan metrics, our loan to assets as at the end of the year was 39%, and our loan as a percentage of investment property was 42%, and our debt to equity as at the end of the year was 65%. Again, we like to compare this to the composite on the REITs that we look at just to show you some context. Typically, the US REITs are about 122% in terms of their debt to equity, right? So we're still very conservative in how we are funded and structured. Okay. And just to highlight a bit of how the cash is being generated to service these debt, to service dividends, and to operate the business, we had cash provided by operating activities, a record, as the chairman said, of $2.5 million this year. And that helped us to have a debt service coverage ratio of 1.6. And that is in comparison to our covenant, which is 1.25. So you see the strong buffer there. And our interest coverage of 2.97, again, a debt covenant of 1.5. So again, you see the level of coverage that we have in terms of being able to service our debt obligations, and as we move to be able to distribute dividends and manage the operation of the business.
I guess you were all dazzled by all those numbers, but we're going to talk about the engine that makes all of this drive. And there are certain key pillars to the growth of this company and the sustainability of this company. I mean, last year I introduced you to our pyramid of success. So there are three critical pillars for our success. And some of you are finance people, understand the bottom-up strategy. So it really is just like any foundation. It relies on the people. And the people is the board, the staff, all the stakeholders. And particularly because we must acknowledge that the success of this business really has to do with the stewardship of this entity, and that starts with the board as well as our strong team. And let me just introduce you to the team members who are here. Already you know myself, Kevin Richards, CEO, Henry Francis, our CFO. You met Tatisha Rowe earlier, our senior executive for operations. Other team members are there. Roxanne Kelly, who is our financial controller, has been with us for a while. Chadwick Brown, who just joined us as an investment and risk analyst. Kelsey, you're hiding. Kelsey Sterling, who is is in the finance department. Andrew Hart is over there, is our property officer. Tiana Card, who is our admin officer. Javon Rose, our property and building manager, Nichelle Jackson, another senior account manager, and Tanya Williams, hiding in the back, who's also been a strong pillar of the organization. Each person brings a different, not just skill, but personality that helps to build our culture. And culture is an important thing in our organization, because when you have a strong culture, it helps you to deliver on the results. We have had a strategic plan that we've had in place for a number of years. And one of the things that we do, we ensure that everybody owns that strategy. You understand, you're part of that process. Once you are part of that process, then you would own and understand what the strategy is. But what describes our culture is, we are supportive, respectful, family, goal-oriented. I would say spiritual as well. We are, how did I forget Lamar? He's sitting right here. Thanks, dear. Lamar, who is our real estate analyst, and the one who put together all of these things. So just a word of, some acknowledgement for Lamar for putting together all of this presentation for us today, keeping us all on our toes. Never met a more meticulous person. But going back to our culture, one thing that's not there is that we're a spiritual organization, and by spiritual I mean faith-based. It is very important. We started the AGM with prayer. That's how we start our board meetings and all of our meetings at the office. But also we mix fun in there, because there has to be balance. And all of that is important in building a strong culture within the organization. And to keep that going, we continue to invest in training and development, and we have a good system of feedback within the organization that helps everybody to develop and grow. Next one. Now, ESG, the chairman had touched on the G part before, which is governance, and we have made strides in many of those areas. Particularly, I am proud of the strides we've made in terms of the environment. We were one of the first companies, listed companies on the exchange, to actually develop a green policy and focus on it. You'll see, if you go back into several of our previous annual reports, you'll notice that we've stated what our green policy is, what our sustainability goals are, and we continue to work assiduously towards achieving best-in-class standards. We maintained our gold standard on certain properties in 2024. I think 2023 was the first year we got our gold standard, and we maintained that in 2024. We're expanding that to more properties within the portfolio, and also having discussions with our international partners, particularly in the UK, about getting certification on those buildings in the UK. We not only keep it to ourselves. Our green policy, we incorporate all our stakeholders. So our tenants are part of the process, the communities where we have properties are part of the process. And when I say the communities, just not the adults, but we have a strong program where we work with the schools in some of these communities where we have properties, get them into the business of recycling and understanding the impact on the disposal of trash items and how that can have an effect on the environment. We engage in beach cleanup activities, all of those things. And I think you'll see in the annual report how our work in sustainability is reflected according to the UN Sustainable Goals 2030, all the achievements we have, the specific goals that we target, and the specific activities around those goals that we engage in. In terms of solar and alternative energy, we've worked with one of our tenants who installed a new solar system, and we're looking at solar across a number of our properties going forward. On the social side, we work, as I said earlier, with the communities where we have properties. And we're proud of some of the main activities that we had last year. Last year was the second year we had a handover of a house to a family in Callaloo Mews, which is a community, again, near where we own properties. This is a program that we're very proud of. I mean, when we see the impact that getting this house has had on some of these people, you know that you're actually doing something good. Speaking of Callaloo Muse, the school, a couple weeks ago we had a reading exercise at the school, and I think the team members really had an eye-opening, enjoyed the entire experience. But it's important that we work with the youngsters because they are the future of this country. And one of the things that we are so aligned with the principal and the staff at Callaloo Muse Basic School is that the vision there is basically, it is a school within a, what do you call it, inner city community, but there is no reason why a school such as that should have any less resources or opportunities as a school that is not in an inner city community. So we work, that's something that we are aligned with, and we work with the principal towards that goal. And of course we support, basketball. I have to say that's probably one of my pet projects. I'll claim that's my bias there. So let's talk about the portfolio, because we have the people, now we're at the portfolio, the properties. We've been working on a diversification strategy, a geographic diversification strategy for a number of years. I go back to the end of 2016 when our portfolio was 70% in the US and 30% in Jamaica. It looks vastly different as at the end of 2024, and even since the acquisition of an additional UK property, it's different from this. So this is what the portfolio composition looks like at the end of December 2024, where we're 44% in the Cayman Islands, 44% in Jamaica, 5% in the US, and 7% in the UK. And as I said, since we acquired Dorking, that has shifted more towards the UK. I think we're about 11% in the UK now. But also we're diversified against different subsectors. Obviously with the acquisition of 2 office buildings in the UK, the office component has moved to 40%. And the thing about office is that office is opportunistic, which is the basis of our strategy, finding where the opportunities are. Office has been knocked down for a number of years since the pandemic, and we've been able to pick up deals that are very attractive but also are sustainable, meaning they have good tenant bases, strong leases with long terms until expiry of those leases. Industrial is also another area that is strong, and we still maintain. Most of those properties are in Jamaica, but we are looking at industrial opportunities outside of Jamaica. And retail, with the acquisition of the Grand Harbor property in Cayman Islands, our retail component has increased significantly. And retail is actually one of the fastest growing. If you look at international REITs, retail is the fastest growing segment now. Again, opportunistic. You remember a few years ago, people were running away from retail. Now people are moving back to it. Next slide. Now, the chairman had mentioned about the movement of the stock price since 2019. And 2019 is a specific year we chose because we had a capital market event in 2019. We had a rights issue in 2019. And again, we had another one in 2022. So if you had bought into that rights issue, and I'm sure there are a lot of you here that became shareholders then or picked up more shares during that offer, if you had invested $10,000 US in that offer, today that $10,000 US would be worth $15,000. This is at the end of December. Would be worth $15,175. That's a 50% growth in US dollar terms if you had invested in the stock. Now, there's a reason why our shareholder meetings have been growing significantly, because clearly a lot of people are happy with the investment that they've made in KP because they've seen this level of growth in the stock. This is what we spend our days and sometimes nights working to ensure that this growth continues so that our shareholders and our stakeholders are content. When you look at that from a standpoint, because, sure, we've had great performance, but how is that performance relative to something else? And the metric we use, obviously, is the stock exchange index, the main market stock exchange index. So our stock price has grown on average 6.05% per annum since 2019, whereas our book value per share And I've always echoed the fact that we're very conservative in our valuation approach. So this book value per share reflects that conservative accounting for fair value. That has grown on average at 7.32% per annum since 2019. Compare that to the main market of the stock exchange, which has on average been negative over that period. So again, as a shareholder, what we do, our main responsibilities as executives, management, team members of KP is to ensure that we're delivering value to our shareholders. And this is the best demonstration of that value. Again, everybody hears us saying what gets measured gets done. So we have key parameters that we measure ourselves against. We've became the first pure real estate investment company listed on the Jamaica Stock Exchange. And from day one, we said we are going to adopt the tenets of a REIT. There's no REIT legislation that exists in Jamaica, but we said we're going to adopt the tenets of a REIT. So that means that everything that we do, we ensure that we're doing it at world-class level. So we compare ourselves largely we've created a composite of international REITs, and we've mimicked it according to the composition of our portfolio. And then we measure our performance against that composite. We've also measured ourselves against a list of other listed real estate companies in Jamaica. And for the most part, we have had a very favorable performance when we compare ourselves to the international composite of REITs. What is different? Let's look at, in terms of the unfavorables for the local composite, is largely on the debt metric, which obviously when we refinanced our debt in 2024, that number would have changed, increased the level, and we saw earlier from the CFO where our debt moved to. But obviously we're not that far off from the rest of the local market. But when you compare ourselves with the international market, we are substantially better or in a more favorable position when it comes to debt relative to equity, capital, or total assets. Another key metric I like to look at is price to book, which is typically international REITs trade at a 1.5 times book value. We're basically trading at book value now. So I always say to people, there's always room to grow in the stock price of KP when you look at how international REITs trade. I won't get into the local composite because they're obviously, different factors. Again, differences, for example, in terms of our level of conservatism when it comes to fair valuing of assets compared to maybe another institution. So I wouldn't be too concerned about what that price to book value ratio is in terms of the local composite. But from a total return standpoint, because there tends to be a lot of focus on dividend yield, what's your dividend yield. But what we've been able to deliver to you as shareholders is a total return that is far better than what other local listed real estate companies have been able to give their shareholders, and as well far better than what the international composite is showing. Any questions on that? All right, well, what's the way forward? Because 2024 was 6 months ago. A lot has happened since then. Where are we heading? And in terms of that, we have to get some context. What is the macroeconomic environment like now? How is the real estate market now? And how all of those things will help to shape our strategy going forward. But the essence is that the expectation is that interest rates will continue to moderate at different paces. We've seen more aggressive moves in Canada and also by the Bank of England and the ECB. The US has been a little bit more conservative in their rate adjustments, but the general trend is for further reduction in interest rates. The view is that inflation is not a significant concern, particularly where UK, European, and US real estate markets are concerned. What is the biggest concern for most persons is the geopolitical uncertainties, and those are the factors that are going to help to drive what investment strategy is across different asset classes going forward. But there is some rising confidence in the property markets in the UK and Germany, the UK, and again, largely because of the beatdown that it has gotten over the years. There is strong confidence in that market. The same confidence being expressed at a global level by, large investment banks is the same confidence that we have in the UK market, which is why we are investing in that market. And typically, that market responds the fastest when interest rates adjust. So the UK, again, good segue into the UK market. When we look at what the normalized investment yields or income yield, net income yields are in different jurisdictions, and we look at the main ones that we're in, Jamaica, Cayman, and targeting of the UK. The UK has the highest normalized net income yield in terms of assets, and that's why we've been so strongly focused on that market. The other thing about the UK too, it's so similar to Jamaica, the same rule of law, or tax. The tax system is very similar. So it was an easy transition to get into the UK market. When we look at, there's specific markets in the UK that we look at. Bristol, which is where we acquired our first property, is one of the fastest growing cities in the UK as well. The office market in the UK has seen a significant increase in transactions over the last 12 months as well. And that's largely being driven by a push for return to office that's been happening in the market in the UK. And particularly because people really, if you're going to want me to come back to the office, you want to get something that's of a higher quality. And that's why we focus on prime assets. A lot of these assets that we're looking at are assets where there has been recent upgrade, where the previous owner would have spent a lot of money upgrading those properties, so they remain attractive for tenants. In terms of Jamaica and the Cayman Islands, again, Jamaica with a 10%, also double-digit normalized yield. Cayman slightly lower, but we all understand the tax neutrality of Cayman, so there's another advantage here to Cayman. What we expect is that the Cayman market will continue to grow because they have a very aggressive policy on growth in the population, and if your population is growing significantly, obviously there's economic activity there, and there will be the need for space, whether it is residential, office, or space for recreation, or which is why we have a strong investment in retail in the Cayman Islands. Jamaica, we also expect to see continued growth. Again, we've seen some of the areas that are growing at a rapid pace in Jamaica, largely the industrial segment and the office segment. So let me just hammer out, because it's always important that we repeat what our strategy is, because this, I think, is our differentiator in the market. And these are the principles that guide us in terms of how we execute on a day-to-day basis to ensure that you get the profits that we were talking about earlier. We're going to continue along that path, and we're going to continue to, find creative ways of how we get to that $100 million in assets under management. We ended 2024 at about 87 million, so we're about 13 million short. So we're going to find creative ways, whether it's through strategic partnerships or capital market events, different ways of getting to that level. We're going to continue to monetize assets in the portfolio. When we do an underwriting for an asset, we usually do it with a whole period of 5 to 7 years. So, we're not wedded to any asset. So we will continue to monetize assets in the portfolio, all at a gain. I'm not trying to sell things, give away things or sell them at a loss. That gain redounds to the shareholders in the form of distributions. And we're going to continue to focus on cash generating assets in the portfolio because, if we're not generating strong cash levels, then we won't achieve the FFO target that we've set for ourselves. We'll continue to identify assets in the UK, and as I mentioned, if we're achieving those FFO targets, then the dividends will continue to flow. And just to wrap up, for the main focus for this year is the completion of the Russell Road development project, which is the 14-unit mini warehouse development that we have near the Crossroads area. We are 20% complete on that project, and we're expecting to complete that within the first quarter of 2026. Now, we are not huge experts in greenfield, so we're very measured in our approach to this. So we started with a project, which is a fairly small size project. Once that's completed, then we're looking at the development of the East Street lots. And you'll recall August last year when we acquired 2 buildings on Duke Street and a parking lot on East Street. The plan then was for the development of that East Street parking lot, and that's something that is slated for 2026. And those are the main focus, and I think it's time for Q&A, so now I can hand back to the chairman.
Just a couple of things. I just want to differ with Kevin on a couple of issues. He showed a great slide there. I don't know if we can go back to it just quickly. The REIT comparable slide. And that really demonstrated a bunch of strengths to me. Yes, that's the slide. That demonstrated a bunch of strengths to me that it may be a bit misleading the way we've structured it here, and I think it's just the conservative nature of local investments. But the debt to equity and debt to capital and debt to total assets appears to be unfavorable when compared to local REITs, because a bunch of local REITs are denominated in J dollars, and so the differences between the gearing you're able to get and the yields you're able to get kind of require you to be less, let's just say, aggressive in the amount of leverage that you take on. Notice that when we compare ourselves to developed country metrics, we are way better off, because in developed countries, the cost of money is a lot lower, and as we see, the cost of our gearing is very, very low, so you're able to take a little bit more risk. And I wouldn't say that debt to capital ratios of 32% when compared to 50% in developed countries, or 29% compared to 46% in developed countries, or 39% compared to 46%, is taking a huge amount of risk. But what you can see clearly is that taking that extra risk results, compared to local REITs, results in much better metrics. Return on equity, 10.3 compared to negative locally. Return on assets, 6.21 compared to 1.29. So the extra debt that we take on judiciously yields better, way better results. And so that's why, everything has a relationship. So that's why, even though it appears those debt to equity and debt to capital and debt to total assets are unfavorable when compared to local REITs, it's not unfavorable when compared to international, and the result of that is way better performance metrics on return on equity, return on assets. The other thing I would say is the price to book ratio, which again, we have here as unfavorable when compared to local REITs. It's not. You want a price to book that is certainly at least at your book value, and hopefully slightly ahead, showing that the market believes that you are worth what your book value suggests that you are worth. And so that's actually a vote of confidence when the market actually values you at least at your book value and even slightly more. Where the rubber meets the road there is your price earnings ratio, the multiple of earnings that you are valued at in the market. And there we are well ahead of the local market, even though we're slightly behind the way more aggressive international market that prices you at 35 times. earnings. So while we have some unfavorables there, from where I sit, these are all favorables, frankly. I mean, we can have that debate if you don't agree, but I certainly believe that this is an entirely favorable comparison. So with that, we can go into Q&A. If anybody, of course, after these results, I'm not sure what the questions would be, but I can see Mr. Rose has a few as usual. So, David. Yeah, man. Good to see you, sir.
Good to see you again, Gary. 2 years to year 10 since going to KPREIT's AGMs.
Sorry?
2 years until 10 years going to KPREIT's AGMs.
Okay.
Yeah, so.
Well done, David.
Good one. So, the first question is, I like the whole strategy going forward in terms of, just continuing to hit that AUM target of $100 million US. But one thing I've realized that KPREIT, typically would have a semi-annual dividend payment, with its first payment due to occur around April/May each year. We're in June and there's no dividend payment. And then I went back to the cash flow statement. I realized that you would have financed most of your recent acquisition of the UK property in Dorchester with your own cash on hand, right? Well, I should say cash.
Some of it, yeah.
So, why didn't the board, consider a dividend relevant period? Is it more so from the prospective projects you have on board, or is it level of concern?
Yeah, look, nobody's more disappointed in that than me.
We know you're a big shareholder, you give me money.
So let me just be clear about that. That is not something that we take lightly. We believe that is why we are here, frankly, to return dividends to shareholders. The fact of the matter is that we engaged last year and are still engaging this year in a fairly aggressive property acquisition campaign. And that, as you have outlined and highlighted, requires cash. So suffice to say, we are always considering when is the best time to return cash to shareholders. This year is going to be no different. So while you have pointed out that you have not seen the usual dividend payment schedule that you have become accustomed to, rest assured that total dividends paid out is going to continue to follow the policy that we've outlined, which is that we're going to pay out, what is that, minimum, Kevin, of 90% of FFO to shareholders in every year, and we're not residing from that commitment at all.
No, so I have no concern in actually meeting it, but you kind of skipped over the main point, which was, is it more so because of all these projects you're doing on board that you're delaying this dividend consideration, or is it because of uncertainty? No, it's no uncertainty. Like I said, we've engaged in a fairly aggressive property acquisition program over the last year, in addition to a greenfield project as part of that property acquisition process, which requires a bit of cash. So I think we've proven, as stewards of your cash and capital, that we invest prudently, and we invest in order to be able to generate the returns and the cash, to be more specific, that we're going to be able to return to you. I think we've proven that over the years, that is what we do. We kind of know how to do it by now after 17 years. So while there may have been a bit of a hiccup here in sort of sticking to the timetable that we usually apply, timing is everything, and the aggressive investment in assets under management now, including greenfield projects, is going to pay off. All right, I appreciate that. So just to follow up then, KPREIT has always done its growth trajectory in terms of a mixture of debt and equity. You mentioned that you're looking at potential partnerships to reach that, targeted goal. So in aim for that target, is it going to be a focus more so on those direct property acquisitions, or something similar to what takes place with the Polaris funds in the USA?
Well, it's going to be opportunistic, right? We apply capital to where we believe we're going to generate the best risk-adjusted returns to shareholders. So again, our history, I think, has demonstrated that we have applied capital to a variety of potential investments.
Frankly, not all of them have performed exactly the way we had planned, but we think our diversification policy has yielded an overall result that is going to continue to inure to the long-term benefit of shareholders. So rather than sit here now and telegraph that we're only going to do this or we're only going to do that, we've sort of focused on the big long-term goal, which is we want to get to $100 million in assets under management, and the return on the capital that you have entrusted us to invest is going to stay in double digits and keep getting higher and higher. That we can promise you.
No, but is it going to be more? Can probably can address it.
Add to that, David, is, for example, I spoke about the East Street Development Project. That's something that we could, when you talk about partnerships, we could be doing that with another partner. That kind of partnership, not something like the Polaris type investment.
No, but at the same time, no. So it's more so. I know that KPREIT still prefers to have their control of the properties themselves, but you're about 85 million worth of AUM right now, vis-a-vis your target of 100 million, which is next year. So
Would still have control.
No, I get that. So is it more so that you're looking? Say, the chairman mentioned opportunistic approach. Is it more so that you would look at those opportunities to take on those great deals via more so like a Polaris-like structure, especially in the current environment, to relatively share risk, or?
Yes.
Yeah, so like I said, I know you're trying to get us to commit to like when we take on a Polaris kind of thing.
I'm not to commit.
Right.
It's more so a sense of direction.
Right, the
direction.
direction.
Of uncertainty, and the thing is that everybody's trying to do more risk sharing to mitigate some level of risk, which is not a bad thing, but at the same time, I know you want to get a higher yield and better control of your returns. So that's where the question's coming from.
No, I get the question. And the point I was trying to make was that I think our history demonstrates that we have afforded investors a mix of various types of investments, including Polaris-type investments. So what I'm asking you to do, David, is to continue to trust us to make the right investments for the times, as we have always tried to do, rather than getting me to say, oh, no, we're going to take more sort of risk sharing as opposed to, you have to balance risk with reward, as you know. And so we're going to continue to balance the risk with the reward based on the environment in which we are operating. So we are acutely aware of the changing and risk-averse approach you need to take in various environments, and we're going to continue to take that approach going forward.
Sure. My next question is, during the Q1, KPREIT had a deposit put down for investment property. Was that related to I don't think it was related to the UK, but what was that deposit put down for?
I think that was Was that Dorking?
Yeah, Q1 2025 deposit on investment property, 450.
Yeah, it was Dorking. It was a new UK property. It was a new UK property, which we have closed now. What happened?
I'm waiting for them to finish their discussion.
No, so we would have deposited on the purchase in Q1, and then would have closed by the end of Q1. So it should have been gone.
You see where the query comes from, though, still. Let me just show you.
So we broke ground on Russell Road and paid additional deposits in Q1 of 2020. So that's the development right.
No, and I appreciate that, but you can at least see why I would have at least show you the financial I'm referring to, so that there's clarity in the whole discussion. And then during Q1, you also transferred the property to held for sale. Is that based on the joint venture arrangement, or are you disposing of property right now in the current period?
Yeah, well, we transfer properties that are imminently about to be sold into held for sale ahead of the actual closing of the transaction. So whatever that number is you're seeing in, and I guess you're talking about the Q1, again, 2025?
Yeah.
Yeah, so by the end of Q1 2025, we would have transferred property that we were in the process of selling to held for sale, which is the IFRS approach to doing it. And you transfer it to held for sale at the likely price that you're going to receive for the property.
So which property is we put up for sale? Spanish Town?
Yes, so we're not going to sort of disclose that, David, until we've actually
I can figure it
disposed
out
of the
though,
property.
I can figure it out still, so it's not like it's complicated.
All right, well, I mean, I'll leave you to your expert. Yeah, I'll leave you to your expert.
Go to see you, Peter. Peter, the numbers are right there. So, once again, still figured it out.
Yes, well, speculate.
So, last year, KPREIT have approved a share buyback program, a one-year program, and the stock price is trading, I think, at or above the book value right now. So I guess they moved to not acquire more shares in period just because of the fact that price is trading above book now, or
Yeah. I mean, the share buyback plan was predicated on picking up shares for our shareholders. Remember, those are who own those shares that's who's made the investment once we've made it. And we know that our company is worth at least book value. So if there are shareholders out there willing to sell shares at below book value, we think that is a good value for shareholders to acquire and take off of the exchange and take off of the register completely. And so we will make those investments. But as you've pointed out, we've not been trading at below book that much. And so we haven't made those purchases.
I realize, I appreciate it. Just to roll back some of the progress that you mentioned in the first quarter, you mentioned that you're able to relet some of the properties and increase occupancy across the entire portfolio to 92%. So in terms of that whole reletting of the portfolio and everything, is that you've also been based on, is it that KPREIT has what one would call a ladder-like lease schedule whereby there is a fixed schedule of lease charges per year that goes up as the lease agreement goes on?
Yeah, I mean, we've built in. Yeah. Annual increases in lease payments are usually structured into 3 or 5 year lease arrangements. So we have annual increments going up usually at the minimum of a minimum of inflationary sort of adjustments.
So when is the next major cliff in a sense in terms of when we're going to see those significant adjustments in the lease rates then?
No, well, they happen every year. So we see increases in lease rates every year of the multi-year agreements with each tenant at each building.
No, I get that. It is the duration. Remember that you don't mention the average lease duration on your report, so I can't necessarily guess or get an estimation in my sense of where the cliffs are going to come in terms of significant adjustments into new lease arrangements. So that's what I was pointing out.
It's throughout the year, basically.
Yeah, exactly.
At least between January, February, March, April.
Yeah, it's not. Yeah, there is no cliff, in other words, or precipice, for lack of a better word. I mean, the idea is you want to structure these in a way that you increase yields ratably over the life of these lease agreements.
So, in respect to the Russell Road property development, how is that progress going so far?
That is progressing. I think we're 20% complete now. As I mentioned earlier, these kinds of construction deals, particularly for warehouse properties now, depend on massive prefabricated steel structures that are made elsewhere that you ship in. So we're building foundation now and going complete that fairly soon. And then, we're awaiting the completion of these massive structures to come in, at which point we're going to be able to move fairly rapidly towards completion. Like I said, I think earlier, we're going to be able to begin leasing warehouse space by the latest January of 2026.
Sure. So I think two or three more questions. So with respect to the East Street lots, there was a sale and leaseback arrangement. So, two properties, the KPMG, the VMBS building, those are fine. With respect to the parking lot, you mentioned a potential development in 2026. So is it that you would be parking lot like structure in downtown be developed or something else?
We're considering a number of options there, one of which is a parking lot, a sort of automated, more modern automated, human intervention light parking lot arrangement downtown, which downtown desperately requires.
Needs.
Yes. So that is certainly one of the sort of options that we're contemplating, and probably the more likely one. I don't want you to run with that as a story, but it's certainly the more likely option that we're considering.
I'm relaxing today, to be honest.
Okay, yeah, well, you look relaxed. Yeah. You look.
No, so you mentioned UK and Cayman. Cayman has become quite a hotbed for your portfolio presence. Over the last couple of years, especially as you mentioned, the continued growth and interest, in that space based on their business activity. And for the UK, you're talking about looking at undivided assets in a relatively still strategic center of Europe. So, not discounting Jamaica, with respect to like the future constitution of your portfolio, is it that, apart from the new Jamaican developments you're working on right now, is it that you look more so towards acquisitions in UK and Cayman going into next year, or is it just diversified as the deals come along?
Yeah, look, the front of the annual report says the gateway to global real estate investment. So, like I said, global means global. There are a couple of things that we look at, right? Stable democracies.
USA is interesting. USA is interesting now, so.
Yeah, we're volatile, extremely volatile for all kinds of reasons, right? But it is a stable democracy with a strong currency, strong rule of law, strong property rights and property laws, absolutely critical. And so that's basically what guides where we look to invest in the world right now. I think we can safely say, having gone out of the Caribbean now to the UK, but these strong currency-based, strong rule of law, strong property rights, jurisdictions are all part of the options that we going to explore. So Kevin and team should be leaving no stone unturned in finding opportunities anywhere where those parameters are in place.
Sure, and the final question is, you going to post the recording on YouTube, or?
Sorry?
Are you going to post the recording on YouTube?
Yes.
Thanks, Kevin. Thanks.
I'd just like your thoughts on the dividend payout ratio. I've noticed that it has consistently decreased over the last 5 years.
You said decreased?
Yeah, decreased.
Decreased?
The dividend payout ratio.
Oh, the ratio.
Yeah, the ratio.
Tell me what page you're on. So.
All right, looking at it, it was it was 2.69% last year. In 2023, it was 3.07. Page 19.
19. Okay. So dividend payout ratio is where, okay, yes, I see it. 22, 38, 76, 20, 65. Well, it's bounced around quite a bit.
Yeah, but it has been trending down.
Well, no, but I would look at the payout ratio in isolation, because as profits grow, then even if the ratio itself is coming down, the absolute number being paid out is probably going up. So you're not going to be able to meet. I mean, if you grow profits from $1 to $100, you can't keep getting 50% payouts. More than likely.
I wouldn't mind.
No, sure. Nor would I. To be clear, nor would I. To be clear. But I think what we have to focus on, because we've got also simultaneously a program of investing in new properties and maintaining existing ones, which is not cheap. We have to prudentially manage the actual cash we have available for dividends. So we focus on the amount of cash we're paying out year over year. as opposed to the payout ratio in an improving profit situation?
Well, yeah, profits have been improving, and at the same time, I noticed the yield has been going down also.
When you said, you mean the dividend payout?
And the yield, the dividend yield.
Dividend yield, yes. Yeah, but as the share price moves, again, as the share price, as we improve, the yields as a percentage are going to moderate, let me say. I mean, I wouldn't say them go down, but they're moderating as our results improve. And I assume, as a shareholder like I am, you want to see improving results. And you want to see us paying out more and more cash to shareholders every year. So, some metrics can be a bit misleading. And so I would implore you to focus on how much cash. Well, first of all, are we improving results year over year? Are we generating more revenue, overall total revenue, profit?
You have been.
Thank you, sir. And then as a result of that, are we paying out more and more cash? Because the bigger that number gets, that denominator gets, the ratio itself is going to moderate, is what I like to say a little bit, in order to manage the sort of competition for cash put on us by the need to pay shareholders out, but the need to manage the business as well and continue to invest and grow the property portfolio, which is the foundation of generating all of this cash in the first place.
Okay.
Thanks. So.
Mr. Chairman,
Yeah, Mike.
I noticed that the relevance of US in the global market is changing, changing quite rapidly. I mean, there's talk of the BRIC countries actually shifting the focus from US. As KP, from KP's perspective, I mean, you're actually continuing to show your financials in US dollars without any kind of relationship to what else is happening in the global marketplace. Any thoughts on how that kind of reporting will change going forward?
Well, no, we haven't given any thought to change. So we actually started issuing results and converted to a US dollar denominated company back, I think, in 2019. I was going to say 18. In 2019, for some obvious reasons, being in J dollars made the results way too volatile, given the, let's just say the stability of the Jamaican dollar. So we wanted to convert to a way more, denominate our business in a way more stable currency. And having done that, now we've seen way less volatile results, so I think that was a solid move. Look, the challenge to the US dollar as a reserve currency is real. It's something we have to obviously keep at the back of our minds. And I think one of the ways you mitigate that potential is to diversify the currencies you're earning rental income in and generating revenues in, which we have begun to do by now actually generating pounds. And again, the fact of the matter is we are a global, I'm very proud to say, we're a global real estate company now. So there is nothing that should be limiting, certainly from a board standpoint and a governance standpoint, nothing limits our ability to diversify the income streams that we are going to be able to generate for shareholders in the future. I think the jury is out on whether the US dollar is going to actually be replaced as the world's reserve currency. There are a lot of factors involved, and the logical question arising from that would be, all right, so which currency? I mean, would it be the Chinese yuan? I'm not going to make that switch now, for sure. I'm going to stay with the US dollar for a little while longer, while it is clear that the Chinese economy is on the rise. And some would say they've even achieved, I think, technological superiority. I don't know how many people have been to China recently, but some would say they've achieved technological superiority. Currency-wise, I'm not sure that we'd be ready to sort of switch to the yuan. But we couldn't even do that if we wanted to. Our ability to be in US dollars is based on the fact that we generate a ton, well, virtually all of our revenue in hard currency and in US dollars.
And I mean, that may be fine, but I mean, just from the perspective of how the information is reported, even a simple comparison of your US reporting to some kind of a benchmark, so that the shareholders can see, well, all right, it can work. I mean, it's working. I'm not asking that you change, how you're assessing your business in US dollars, but, just some kind of benchmark reporting may be useful in light of what's happening. Just a point.
No, that's a good point. In other words, maybe just compare the sort of US dollar to a basket of these other currencies during the year, right? Which is what we'd have to do if we're in J dollars, right? You would look at the exchange rate movement between J and US, and you're saying, no, the US should be looked at as a potentially super volatile currency as well against a basket of currencies, and I don't have a problem with that, given the reality. All righty.
Morning, Douglas Wilson, shareholder.
Yeah, Mr. Wilson.
Yeah. Just a commendation more than anything else, from a personal point of view.
No, we accept that.
Yeah,
we accept those.
I really like the production of their report this year. It's very readable and friendly. One thing I would have liked to see in it, maybe it's in it by my mistake, was that comparable table when you compare it to the other REITs, because I was particularly interested in getting that information, but I had to take a photograph of it.
You mean kind of like the one we Kevin had produced here earlier?
Yeah, that's why.
Yeah, that's nothing. No, we did that for here. All right, cool. Yeah, no,
right,
thanks, Mr. Wilson.
My commendation.
David will take care of that.
Yeah, there's a question-ish. Have you considered Guyana as a possible place for making money in terms of where it's going now and the potential? It's a small market, yes, but it has so much potential. So that's
so Wilson, that is a good point. Like, the cover of the annual report says we're global, so, we'll have to consider everywhere where where we have a stable democracy and, a solid currency and strong rule of law and strong property laws as well. Unfortunately, Guyana doesn't tick all of those boxes, frankly, yet. It just doesn't. It's certainly something we have on our radar right now, but it's in the early stages of a kind of Wild West boom. And to be fair, that is where the opportunity is, right? Absolutely. No, sure. So what I would say is, if I was doing this with just, my meager resources, I would take that risk, right, on myself. But as a steward of everybody's resources in this room and all of our shareholders, we're going to tread a little more carefully. And like I said, Guyana doesn't tick all of those boxes just yet. They're working on it, clearly, because I think they realize that in order to truly develop, they're going to have to tick all of those boxes, but I don't think we're quite there yet. But it's something that's definitely on our radar.
No, I was just following up on the previous shareholders' questions. The annual report is very good as usual, but the secret part of the report, when I say secret, the best part is a presentation by the CFO and the CEO. How can we get copies of those?
Copies of these presentations?
Yes.
I'm sure we can share them.
Yeah, it's not in it.
Yeah, no.
Example, the REIT.
No, sure. No, look, our management discussion and analysis, I think, is pretty good and comprehensive. For the AGM, we do some special slides in order to highlight certain things, but that's a good point. I think that would be taken on board.
Especially the REIT comparison.
Yeah. No, agreed. So we are going to ensure that is included.
Well, it could be a supplemental distribution.
No, absolutely.
It doesn't it doesn't have to be in this. I know, time constraint and so on.
Sure.
And of course, the CEO wants to come with something special, which is not in here. And that is understandable.
Okay. All right.
But we would love to get those good reports
absolutely
by itself.
Yes. And the name was Mr. Fennell?
Fennell, yeah.
Fennell, yes. Okay. All right, Mr. Fennell, definitely. Thank you for that. It's a point well made. Wilson.
Sure. And we couldn't end the question and answer session without acknowledging the absence of Mr. Orrit Staple. Yes, he's truly missed today. I've been reliably informed that he's been ailing for some time, so keep him in your prayers, and we wish him a speedy recovery.
Absolutely. All right, so we get to the most interesting part of any AGM, the audit opinion, to be read by our auditors at KPMG.
Independent Auditor's Report. It is on page 81. To the members of Kingston Properties Limited, report on the audit of the financial statements. Opinion. We have audited the separate financial statements of Kingston Properties Limited, the company, and the consolidated financial statements of the company and its subsidiaries, the group, set out on pages 88 to 131, which comprise the company's and the group's statements of financial position as at December 31, 2024, the company's and the group's statement of profit or loss and other comprehensive income, changes in equity and cash flows for the year then ended, and notes comprising material accounting policies and other explanatory information. In our opinion, the accompanying financial statements give a true and fair view of the financial position of the company and the group as at December 31, 2024, and of the company's and the group's financial performance and cash flows for the year then ended in accordance with IFRS accounting standards as issued by the International Accounting Standards Board, IFRS accounting standards, and in the manner required by the Jamaican Companies Act. Basis for opinion. We conducted our audit in accordance with International Standards on Auditing, ISOs. Our responsibilities under those standards are further described in the auditor's responsibilities for the audit of the financial statement section of our report. We are independent of the company and the group in accordance with the International Ethics Standards Board for Accountants International Code of Ethics for Professional Accountants, including International Independence Standards, IESBA Code. And we have fulfilled our other ethical responsibilities in accordance with the IESBA Code. We believe that the audit evidence we have obtained is sufficient and appropriate to provide a basis for our opinion. Key audit matters. The key audit matters are those matters that in our professional judgment were of most significance in our audit of the financial statements of the current year. These matters were addressed in the context of our audit of the financial statements as a whole and informing our opinion thereon, and we do not provide a separate opinion on those matters. The first matter has to do with the valuation of investment property. The valuation of the group, including the company's investment property, requires significant estimation given the infrequency of trades in comparable properties in other cases and in the absence of a number of observable recent market prices. Significant judgment is used by the group in arriving at the fair value of these properties, the fair value of which is impacted by uncertainty of market factors, pricing assumptions, and general business and economic conditions used in valuing these properties. As part of our procedures, our response to this matter included the following. We used our own valuation specialist to assist us in assessing the reasonableness of the valuation methodologies employed by management, including management experts where applicable, and the fair value conclusion for a sample of properties at the valuation date. We considered the provisions of the applicable financial reporting framework in order to evaluate the adequacy and appropriateness of those disclosures, assessed the sources of data, and challenged the underlying assumptions utilized to value the properties, performed a search for similar transactions and listings to assess the potential fair value changes that occurred within the period. The second key audit matter, fair value of investments. The group uses its judgment in selecting the appropriate valuation techniques to determine the fair value of financial instruments. The estimates of fair value arrived at may be significantly different from the actual price of the instrument in an actual arm's length transaction. The valuation for the group's unquoted investments has been identified as an area of significant risk, given that the measurement of the unquoted investments includes significant assumptions and judgments about expected cash flows and the determination of the discount rate to apply. The group has determined that the fair value of the unquoted investment using the fair value of the unquoted investments using the income capitalization approach in the absence of a quoted price for the instrument on a trading market. As part of our audit procedures, we included the following. We used our own valuation specialist to assist us to evaluate the application of the valuation methodology and the reasonableness of the assumption used in determining the discount rate by comparing the discount rate with published market and industry data and other relevant information. We assessed the reasonableness of the cash flow projections by comparing the input data provided by management with independent data sources for the discount rate, rates of return, supporting documents such as financial statements of the investment company and other information. And we challenged the group's assumptions such as the timing, amounts, and future growth of cash flows by obtaining an understanding of the relevant activities of the investee, evaluating historical performance and financial position, using our knowledge of the industry in which the investee functions, and determining whether there may be variations to the contractual cash flows expected based on the knowledge obtained from our evaluation of the investee. We assessed the adequacy and appropriateness of the group's disclosures against the requirements of IFRS 13, fair value in measurement, and IAS 1 presentation of financial statements, see notes 12 and 28, to determine if these adequately illustrate the key risks determined in this key audit matter. And I'll turn to page 5 of the auditor's report to read the report on additional matters as required by the Jamaican Companies Act. We have obtained all the information and explanation which, to the best of our knowledge and belief, were necessary for the purpose of our audit. In our opinion, proper accounting records have been maintained so far as appear from our examination of those records, and the financial statements, which are in agreement therewith, give the information required by the Jamaican Companies Act in the manner required. The engagement partner on the audit resulting in this independent auditor's report is Karen Raghuber Singh, signed by KPMG, Chartered Accountants, Kingston, Jamaica, March 3, 2025.
So now we're going to vote on the various resolutions. Essentially the last bit of official business of the AGM. So notice is hereby given that the 17th Annual General Meeting of Kingston Properties will be held at the Courtleigh Hotel and Suites. Okay, I just need to go to the resolutions. Resolution number 1, that the audited accounts for the year ended December 31st, 2024, along with the reports of directors and auditors circulated with the notice convening the meeting be and are hereby adopted. Could I have a proposer? Thanks. David Rose. Second. Sorry, your name, ma'am?
Beverly Gustav.
Seconded by Beverly Gustav. All in favor? All opposed? That motion carries. Thank you. The next resolution, resolution number 2, that the interim dividend of US $0.000566 per share paid on June 5th, 2024, and US $0.001058 per share paid on December 18th, 2024 be and is hereby declared as final for the year ended December 31st, 2024. Can I have a proposer? David Rose again. Seconder? Douglas Wilson. Those in favor? Is there any opposition? No? That resolution carries. Resolution number 3, that Mr. Peter Reid, retiring by rotation, be and is hereby re-elected. Can I have a proposer? Ms. Gustav, seconded. Your name? Mr. Bloomfield. Those in favor? Those opposed? That resolution carries. Resolution number 4, that Miss Lisa Gomes, retiring by rotation, be and is hereby re-elected. Could I have a proposer? David Rose. Seconder. Ms. Gustav again, seconded. Those in favor? Those opposed? That resolution carries. Thank you. And then resolution number 5, that KPMG, having signified their willingness to continue in office as auditors, the directors be and are hereby authorized to agree to their remuneration in respect of the period ending with the next annual general meeting. Can I have a proposer? David Rose. Seconded. Ms. Frey. Those in favor? Any opposition? No. That resolution carries. Thank you, ladies and gentlemen. This brings the official portion of the annual general meeting to a close. Again, on behalf of the management and team at KPREIT, we thank you for your continued support and take your support. Don't take that support for granted at all here, certainly as a board, and we're going to continue, hopefully to keep executing the plans we have and to achieve the goals that we've set for ourselves as a business, and hopefully you are going to see the results in the dividends you receive and in a continually improving stock price. So thank you very much. Appreciate it. There being no further business to conduct, the meeting is terminated. Thank you.